Today on Open Exam Prep, we're tackling a critical section for the Series 6 exam, the web of SEC and FINRA regulations that govern investment companies. We will start with the foundational law, the Investment Company Act of 1940. This act was established to create a stable structure for investment companies and, most importantly, to protect the investing public. The exam requires you to know exactly what constitutes an investment company. The key is the 40% rule, which states that a company is considered an investment company if more than 40% of its assets are invested in securities. An exam question might give you a company's balance sheet and ask you to determine if it must register. Once a company meets that definition, it must register with the SEC. To help you remember the registration triggers, use the simple phrase 100-100. A company must register once it has 100 shareholders and $100,000 in assets. The 1940 Act also dictates the internal structure of a fund, particularly its board of directors. A common exam topic is the board's composition. The rule states that at least 40% of the board members must be independent, meaning they are not otherwise affiliated with the fund. However, a frequent trap on the exam involves the 12B1 fee, which is a fee used for marketing and distribution. If a fund charges a 12B1 fee, the requirement for independent directors increases to a simple majority, meaning more than 50%. The exam will test this by giving you a scenario and asking for the required percentage of independent directors. Beyond structure, the Act also empowers shareholders by giving them voting rights on significant changes to the fund, such as a change in investment objectives or the election of board members. While the 1940 Act governs the fund itself, FINRA's conduct rules govern how you, as a registered representative, sell these products. The most important of these is the suitability rule. Every recommendation you make must be appropriate for your client based on their financial profile, investment objectives, and risk tolerance. An exam question will almost certainly present a client scenario, for example, a retiree needing income and capital preservation, and ask you to identify an unsuitable recommendation, like an aggressive small-cap growth fund. The exam also heavily tests prohibited sales practices. A great way to remember two of the most common violations is with the phrase, "Don't sell dividends or break the points." Selling dividends is the unethical practice of encouraging a client to buy mutual fund shares just before the dividend is paid. This is a violation because the fund's share price will drop by the amount of the dividend on the ex-dividend date. This means the client receives no actual benefit, but they do incur an immediate tax liability on the dividend payment. Breakpoint sales are another major violation. This occurs when a representative sells a fund in an amount just below a dollar threshold, or breakpoint, where the client would have received a lower sales charge. For instance, knowingly selling a client $49,000 of a fund when a significant sales charge discount is available at $50,000 is a prohibited practice. Your job is to inform the client of these breakpoints, not to avoid them for a higher commission. Finally, remember that all communications with the public must be fair, balanced, and not misleading, always including the disclaimer that past performance does not guarantee future results. The 40 Act sets up the game, but the FINRA rules dictate how you must play it.